Ladies and gentlemen, today I want to start with a simple question. What happens when the world's biggest financial institutions stop agreeing with each other? History tells us that when giants collide, markets move, narratives break, and opportunities are born. Right now, we are witnessing one of those moments. On one side stands Bank of America, confidently projecting limits on silver's future. On the other stands BNP Paribas, quietly but decisively challenging that view. This is not just a disagreement between banks. This is a warning signal, a wake-up call, and possibly the opening chapter of what I call the 100 War on Silver. Bank of America represents the voice of consensus. Its outlook reflects stability, controlled expectations, and the belief that silver will remain contained within familiar price ranges. That narrative is comforting. It tells investors that the system is predictable, manageable, and safe. But markets do not reward comfort. Markets reward those who recognize change before it becomes obvious. And that is where BNP Paribas enters the story. BNP Paribas has effectively drawn a line in the sand. By defying Bank of America's silver outlook, it is signaling that the underlying fundamentals no longer align with the old assumptions. Physical supply constraints, rising industrial demand, geopolitical fragmentation, and monetary uncertainty are reshaping silver's role. Silver is no longer just a metal. It is becoming a strategic asset again. When a global bank challenges consensus, it is not acting on emotion. It is acting on data, pressure, and forward risk. Here is the hook you must not ignore. Big money never fights publicly unless the stakes are enormous. This is not about a $5 move or a short-term trade. This is about whether silver remains suppressed or reclaims its historical role as a monetary hedge and industrial backbone. The idea of 100 silver sounds extreme only to those who look backward. To those who study cycles, it sounds familiar. Every major bull market begins with disbelief. Gold was once too expensive at 300. Oil was finished at 20A. Bitcoin was dead at 3,000. The crowd is almost always late because the crowd waits for confirmation. BNP Paribas is not waiting. It is positioning. And when institutions position early, it is rarely for small gains. It is for survival and dominance in the next cycle. This is where motivation meets economics. You must understand that markets are reflections of human behavior: fear, denial, confidence, and eventually panic. Bank of America's stance represents the final confidence of the old regime. BNP Paribas represents the quiet urgency of the new one. When those two collide, volatility is not a risk, it is an opportunity for those prepared. Do not ask whether silver can reach 100. Ask instead what happens if trust in paper markets weakens, if industrial demand accelerates faster than supply, and if capital rotates away from overvalued assets into tangible value. Ask what happens when everyone rushes to the same door at the same time. Prices do not move gradually in those moments. They gap, they shock, they reset. When major financial institutions publicly diverge on the outlook for an asset like silver, it signals far more than a routine analytical disagreement. These institutions operate with access to global data flows, proprietary research, and real-time market intelligence that retail participants never see. Their forecasts are not created in isolation. They are stress-tested against macroeconomic models, supply chain data, geopolitical risk assessments, and internal risk exposure. When two such entities reach opposing conclusions, it suggests that the existing framework used to value silver is no longer stable, and that underlying economic forces are shifting in ways that can no longer be explained by traditional assumptions. This kind of divergence typically appears at inflection points, not during periods of equilibrium. In stable markets, institutional views cluster tightly because inputs align and risks are predictable. Disagreement emerges when those inputs begin to conflict with each other. Physical availability may be tightening while paper supply remains abundant. Industrial demand may be accelerating faster than official projections. Monetary conditions may be signaling long-term inflation risk while short-term policy rhetoric insists on control. These contradictions force institutions to choose which signals to trust, and that choice reveals where they believe the future risk truly lies. Here is the critical hook most investors overlook. Large institutions do not challenge consensus unless the cost of being wrong is smaller than the cost of being late. Reputational risk alone discourages deviation from the dominant narrative. When a bank steps outside consensus, it is because internal models are flashing warnings that outweigh the comfort of conformity. That decision is rarely about chasing upside. It is about protecting capital in a changing regime. In economic history, The first visible cracks in consensus often appear just before markets reprice sharply. Institutional divergence also exposes stress within the system itself. Pricing models depend on assumptions about liquidity, trust, and market depth. When those assumptions weaken, forecasts fracture. Silver, in particular, sits at the intersection of monetary psychology and industrial necessity, making it especially sensitive to structural change. A disagreement at the institutional level implies uncertainty over whether silver should be priced primarily as a financial instrument or as a constrained physical resource. That uncertainty is not academic, it determines how capital flows respond under pressure. The most important insight is that markets rarely move when everyone agrees. They move when confidence breaks. Divergent institutional views act as early warning signals that confidence is no longer uniform. By the time consensus reforms around a new narrative, price is already adjusted. Those who understand this dynamic do not wait for clarity. They recognize that disagreement itself is the signal, and that structural change always announces itself quietly before it becomes unavoidable. Silver occupies a uniquely powerful position in the global economy because it is not confined to a single function or narrative. It is simultaneously a monetary metal, a store of value trusted across centuries, and a critical industrial input embedded in modern technology. This dual role creates a structural tension that few assets experience, and it is precisely this tension that amplifies silver's price sensitivity during periods of economic transition. When demand from both financial and industrial channels begins to rise at the same time, traditional pricing models struggle to keep pace. From an industrial perspective, silver is not optional. It is one of the most conductive and reflective metals known, making it essential for electronics, solar panels, medical equipment, and advanced defense applications. As global economies push toward electrification, renewable energy, and digital infrastructure, silver consumption becomes non-negotiable. Unlike many commodities, silver has no scalable substitute that can match its efficiency without sacrificing performance. This creates a form of inelastic demand, where usage continues regardless of price fluctuations, especially when tied to government-backed industrial policies and long-term infrastructure commitments. Here is the hook: most markets underestimate industrial demand, does not negotiate with price the way investors do. A solar manufacturer does not pause production because silver is expensive. It secures supply because failure to do so threatens the entire business model. When this reality collides with investment demand driven by inflation fears, currency risk, or declining trust in financial systems, silver faces pressure from both sides at once. This is where price sensitivity intensifies, because supply cannot respond quickly enough to satisfy competing demands. On the monetary side, silver's role emerges most forcefully during periods of uncertainty. Historically, when confidence in currencies weakens, capital seeks assets with intrinsic value and limited supply. Silver, often overshadowed by gold, becomes the high beta expression of that shift. It moves faster, reacts harder, and attracts both institutional hedging and speculative capital. The result is a feedback loop where rising prices validate the monetary narrative, pulling in even more demand. The structural limitation lies in supply. Silver production is largely a byproduct of mining for other metals, which means output cannot be rapidly increased in response to price signals. This rigidity transforms demand growth into price pressure rather than volume expansion. When an asset with inelastic supply meets synchronized demand from industry and finance, repricing is not gradual, it is abrupt. This is why silver does not drift into higher valuations. It accelerates, forcing markets to adjust expectations in compressed timeframes that leave little room for complacency. Silver's price is largely discovered in paper markets, where futures contracts, options, and derivatives vastly exceed the volume of physical metal available for delivery. This structure has worked for decades because it relies on confidence that contracts can be rolled over, settled in cash, or offset without triggering large-scale delivery demands. However, when confidence begins to erode, the imbalance between paper claims and physical supply becomes impossible to ignore. The market may appear liquid on the surface, but beneath it lies a structure that depends on participants not asking for the metal itself. The critical hook here is simple and uncomfortable. Paper markets function smoothly only as long as most players agree not to test them. Once even a small portion of institutional capital starts questioning counterparty risk or availability, the entire pricing mechanism comes under pressure. Silver is particularly vulnerable because the ratio of paper claims to physical ounces is exceptionally high. In such an environment, price is not a reflection of abundance. It is a reflection of trust. Recent shifts in global finance are intensifying this pressure. Rising geopolitical fragmentation, sanctions risk, and the weaponization of financial systems have forced institutions to reconsider the safety of purely financial exposures. Physical assets eliminate counterparty risk, and silver, due to its affordability and industrial necessity, becomes an attractive alternative. When institutions move from paper exposure toward physical allocation, they are not speculating, they are reducing systemic risk. That shift, however, drains available inventory and tightens the physical market far more quickly than futures prices initially suggest. Another overlooked dynamic is the role of delivery stress. Futures markets are designed around the assumption that only a fraction of contracts will ever result in physical delivery. If that assumption is challenged, even marginally, exchanges are forced to manage shortages through higher margins, cash settlements, or rule changes. Each of these responses signals stress, and stress changes behavior. Participants begin to hedge differently, premiums rise in physical markets, and price discovery slowly migrates away from paper benchmarks. What makes this situation especially potent is that repricing does not require a full breakdown. It requires only enough doubt to alter behavior. When investors begin to ask not, "What is silver worth?" but "Can I get it if I need it?" the market enters a different phase. In that phase, scarcity is no longer theoretical, it becomes actionable. History shows that once confidence in paper representations weakens, physical assets reassert their value rapidly. The shift is subtle at first, almost invisible, but once it accelerates, price adjusts not to forecasts, but to availability, and availability, in silver, is far more constrained than the paper market implies. Monetary policy has entered a phase where traditional signals no longer carry the authority they once did. Central banks continue to speak the language of control, stability, and normalization, yet the economic backdrop tells a more complex story. Persistent inflation pressures, record sovereign debt levels, and rising fiscal dependence on monetary accommodation are quietly reshaping how institutions assess risk. In this environment, valuation models built on low inflation, strong currencies, and predictable policy responses begin to lose relevance, forcing a reassessment of assets that exist outside the monetary system. The key hook often missed is that currency risk is no longer a theoretical concern, it is an embedded feature of the global economy. When governments rely on debt expansion to sustain growth and social stability, the purchasing power of fiat currencies becomes a policy variable rather than a constant. Even when headline inflation moderates, the long-term trajectory of currency dilution remains intact. Institutional investors understand this distinction. They are less concerned with short-term rate decisions and more focused on the cumulative effect of monetary expansion over time. Silver benefits directly from this shift because it does not depend on policy credibility. Unlike bonds or cash equivalents, its value is not anchored to promises made by governments or central banks. As confidence in those promises weakens, even subtly, real assets gain relative appeal. This does not require panic, it requires recognition. The moment investors begin to price in the probability of future debasement, rather than react to current inflation data, traditional valuation ceilings for metals start to break down. Another layer of pressure comes from the global nature of currency risk. Competitive devaluations, trade realignments, and fragmented monetary systems increase the incentive to hold assets that transcend national balance sheets. Silver, priced globally and demanded physically across borders, fits this role more naturally than many financial instruments. When capital flows adjust to reflect this reality, valuation models based on domestic metrics become insufficient. What ultimately forces change is the asymmetry of risk. The downside of holding depreciating currency assets compounds quietly, while the upside of real assets often arrives suddenly. Institutions adapt to this asymmetry by gradually reallocating long before narratives shift publicly. As this process unfolds, silver's valuation is no longer constrained by historical price ranges, but reframed through the lens of monetary preservation. In such conditions, price does not respond linearly to policy changes, it responds to credibility, and credibility, once questioned, is rarely restored quickly. Consensus forecasts carry an illusion of safety. When most analysts agree on price targets and future ranges, it creates the impression that uncertainty has been tamed and risk is fully accounted for. In reality, consensus is often a byproduct of shared assumptions rather than accurate foresight. Economic models rely heavily on historical data, linear relationships, and stable correlations, all of which tend to break down at inflection points. This is why consensus projections are most confident precisely when they are most vulnerable to being wrong. The hook that separates prepared investors from reactive ones is understanding that markets do not change direction. Gradually, when fundamentals shift, they change character. At turning points, price behavior becomes nonlinear. Small imbalances produce outsized moves because existing models are not designed to capture regime change. In such moments, consensus forecasts lag reality not by months, but by entire phases of the cycle. By the time revisions appear, the market has already repriced. Silver exemplifies this dynamic because its market is relatively small, thinly supplied, and highly sensitive to capital flows. When demand crosses a threshold, there is no smooth adjustment mechanism. Instead, prices jump as participants rush to re-evaluate assumptions that once seemed immovable. Forecasts that cap upside based on historical resistance levels fail to account for structural constraints, such as limited physical availability or synchronized industrial and monetary demand. Another overlooked factor is behavioral reinforcement. Consensus does not merely reflect opinion, it shapes behavior. Risk managers, fund mandates, and allocation models are often anchored to prevailing forecasts. This creates a self-reinforcing loop where positioning remains conservative until price action itself forces reassessment. When that reassessment occurs, it is rarely incremental. It manifests as sudden capital rotation, momentum-driven inflows, and a rapid abandonment of outdated targets. Institutional players who anticipate these dynamics do not wait for confirmation. They recognize that the greatest opportunity lies where uncertainty is rising but not yet acknowledged. When a respected institution deviates from consensus, it is often because it sees stress building beneath the surface, stress that models have not yet incorporated. In commodity markets, and especially in silver, these moments tend to precede sharp repricing events. The deeper insight is that consensus is backward, looking by design. It extrapolates from what has been, not what is emerging. At inflection points, relevance shifts from precision to adaptability. Those who understand this do not ask whether a forecast is popular. They ask whether its assumptions still hold. When they no longer do, the magnitude of the next move is often far greater than anyone was prepared to admit. Large institutions rarely move in response to headlines. They move in anticipation of them. Their capital allocation decisions are shaped by probability, asymmetry, and long-term risk rather than short-term narratives. When these institutions begin repositioning, it is usually subtle, fragmented, and almost invisible to the broader market. This early phase is not designed to generate attention, but to minimize impact and avoid signaling intent. By the time positioning becomes obvious in public data or media commentary, the most favorable entry points have often already passed. The hook that deserves attention is this: institutions do not need certainty to act, only a shift in risk balance. When the downside of inaction begins to outweigh the reputational and financial cost of being early, capital moves. In silver, this dynamic is especially pronounced because the market's depth is limited relative to the size of institutional flows. Even modest reallocations can strain liquidity, tightening supply and increasing volatility before prices visibly respond. Strategic positioning often begins through indirect channels, adjusting hedges, increasing exposure via derivatives, or securing long-term physical supply agreements. These moves are defensive as much as they are opportunistic. Institutions understand that in periods of structural change, access matters as much as price. Ensuring exposure before competition intensifies becomes a form of risk management rather than speculation. As positioning builds, volatility follows. This volatility is not random, it reflects competing time horizons and information asymmetry. Short-term traders react to price movements without understanding the structural drivers, while long-term capital absorbs weakness and accumulates exposure. This interaction creates sharp reversals, false breakdowns, and sudden rallies that discourage late participants and reward patience. The most important insight is that public repricing is always the final stage. Markets do not announce transitions, they reveal them through behavior. Rising volatility, changing correlations, and inconsistent reactions to news are all signals that positioning is underway. In silver, these signals are often dismissed as noise until price breaks decisively higher, forcing narratives to catch up. By the time analysts revise targets and consensus shifts, institutions are no longer building positions, they are managing them. At that stage, risk reward dynamics change for everyone else. Understanding this sequence is critical. Strategic positioning is not about predicting exact outcomes, but about recognizing when the structure of the market is changing. Those who wait for clarity usually pay for it through higher prices, greater volatility, and reduced opportunity, while those who act early benefit from the quiet advantage that only preparation provides. So let me leave you with this final thought. The 100 War on Silver is not about predicting a price. It is about recognizing a shift in power. When respected institutions openly disagree, they are revealing stress beneath the surface. History shows us that those who listen early are not lucky, they are prepared. You do not need to fight the banks. You need to watch them. Learn from their conflicts. Understand their signals. Because in every financial war, wealth is not transferred from the bold to the cautious. It is transferred from the unaware to the aware. Stay curious. Stay disciplined. And above all, stay ahead of the narrative. Because by the time silver's story becomes obvious, the war will already be over.